Good morning and welcome to today's webinar hosted by the Retirement Advantage. Hope everyone and their loved ones are well and healthy. Today we will be discussing how the demand stays strong for cash balance plans during the pandemic. My name is Bill Sunigal, Marketing and Communications Director for the Retirement Advantage, and today's presenter is John Markley, TRA's Director of Industry Relations. Before we start, I just wanted to give you a little background about John. Now, John started Markley Actuarial over 30 years ago, and in 2018, Markley has been a division of TRA. John's actuary efforts have helped TRA increase sales and build distribution of cash balance plans nationwide. John is a visionary in the retirement plan industry, and we're honored to be partnered with him and his team. Now, I just wanted to take a moment to review the functionality of GoToWebinar. Your active participation is very important throughout this session. Everyone that logs in is on mute just to avoid background noises that may distract you from listening to the webinar. You do, however, have the ability to submit questions using the chat or questions pane located on the right side of your screen. There you can enter your questions and comments throughout the presentation. Your questions will be answered at the end of the webinar during the Q&A session. If we're unable to answer your question due to time constraints, TRA's respective regional sales consultant will reach out to you personally to answer any additional questions you may have. Without further ado, here's John Markley.
Thank you, Bill, and good morning, everybody. This is John Markley speaking, and I'm looking forward to our presentation today. So let's look at today's topics. So we'll start out with why TRA, why the Retirement Advantage, cash balance at a glance to give you a little background on what a cash balance plan is. What's different in 2020, a flurry of activity that impacts cash balance plans has occurred at the end of 2019 and into 2020, and we will go over those. And then specifically, we'll go over the SECURE Act with the impact of new legislation. We want to help you qualify candidates for cash balance plans, and we'll provide you with successful sales approaches and timelines for the 2020 selling season. So the first topic on the agenda is why choose the Retirement Advantage. So the Retirement Advantage is specifically designed to partner with financial professionals who understand retirement plans. That's our only business. We're not investors. We're here to help financial advisors grow their book of business in the retirement plan marketplace. We look to share our expertise to ensure mutual business growth. We'll show you the depth of TRA shortly and provide a seamless partnership for a better client experience. So I really like this next slide. TRA is in all 50 states, so you'll see that we have a regional sales consultant that covers each state of all the 50. TRA has been in business for 24 years, 8.5 billion assets under administration, over 226 retirement plan experts, that's employees throughout the country, 8,500 plans, and 17 sales consultants nationwide available to help you out to get new clients and to go from there. So now let's jump into cash balance plans at a glance. So this is a relatively new field, at least in the last 20 years. In the year 2001, by IRS Form 5500s that are filed with the government, there were 1,337 cash balance plans. Now there are over 23,000. There's been double-digit growth in recent years. I expect that growth to continue even during the pandemic. We'll share with you some numbers right below here on what TRA has experienced so far this year. I'll also mention that I've been around since the early 80s in this field, and in the early 80s, there were over 80,000 small defined benefit plans, which are comparable to today's cash balance plans. So I see the potential for growth up to 80,000 and beyond, given our current demographics. So current trends, cash balance plans now top 1 trillion in assets with 12 million participants. Through June 30th, TRA has experienced a 36% increase in new cash balance plans year to date. So, and keep in mind, many employers wait until the last minute to implement a cash balance plan. There's clearly a demand for cash balance plans out there as we speak, even with the pandemic. So cash balance plan adoption is still growing even in a pandemic. And by the way, of course, we have an existing book of cash balance plans, and we certainly have some clients who have had challenges with the contributions for the 2019 and 2020 year, and we're here to help them not only after the plan is implemented, but service after the sale. So what is a cash balance plan? So a cash balance plan looks like a defined contribution plan because each participant has an account balance. The participant's account balance is a hypothetical account balance, which is annual, which starts at 0 in most plans, and then is typically credited with pay credits, which can vary by participant and by participant. So it could be 1% or one fixed dollar amount for one participant and a different one for another participant. And then interest credits, which is something that most financial advisors are very interested in. Actuarially, we determine the hypothetical account balances and the funding requirements on an annual basis. But even though it looks like a defined contribution plan, you'll see later in the presentation that the contribution and benefit limits are related to a defined benefit plan. So there's increased opportunity as an individual approaches a retirement age to make a tax-deductible contribution. Also, plan assets of a cash balance plan are invested in a pooled account. There's no participant investment direction. So you as the financial advisor can select your broker-dealer and come up with an investment approach on how to invest the assets under the plan. So there are significant tax benefits to a cash balance plan. Of course, first of all, there's federal income tax. There might be state and local income tax. And then we thought we'd list the other benefits, 3.8%. Well, I won't go through them specifically, but a cash balance contribution reduces an individual's income for tax purposes for not only federal income, state and local taxes, but also the other items that you list here. So often we will have a potential client who says, well, I'm in the 30% tax bracket, when in fact they are in a much higher tax bracket, and the tax savings by virtue of having a cash balance plan is much greater than what they initially think. And of course, cash balance plans also allow for substantially larger tax-deductible contributions than a SEP or a 401k plan. And we will have more on that as we go through the presentation. And then the big one from the Tax Cuts and Jobs Act is the qualified business income deduction. So you can get the qualified business income deduction in two ways. The first one is if capital is the source of income for the business. However, many professionals and solo employers do not fall into that category where capital is the source of income production. But if your income is below certain levels for those individuals, you again qualify for the qualified business income deduction. So those limits are $213,000 for a single return or $426,600 for a joint return. So to briefly review again, if a doctor or some other professional can get their income below those levels, they become eligible for the qualified business income deduction and making the benefit of your cash balance contribution even more significant. Pardon me, I went the wrong direction on my slides. So here we have an example of an individual utilizing a cash balance plan or not utilizing a cash balance plan. So, and this is let's say a solo business, and they're structured as an S corporation. So their W-2 compensation is $150,000, and they have additional earnings which could be eligible for a qualified business income deduction of $300,000. Let's say that they file a joint return, so they have income of $450,000, so they are not eligible for the qualified business income deduction. But let's say this same individual establishes a cash balance plan with a contribution of $175,000. So now their qualified business income deduction after the cash balance contribution is $125,000. That is $300,000 minus the $175,000 that they put into the cash balance plan. And now they're going to file their joint return with income below the $426,600 level that we talked about in the prior slide. So they are eligible for a qualified business income deduction. It's 20% of that $125,000 number. So now their taxable income is $250,000. So remarkably, by contributing $175,000, this individual has reduced their taxable income by $200,000. So the level of tax savings could be significant in this case. Now, this doesn't apply in every situation, but we have certainly worked with several employers over the last few years related to the Tax Cuts and Jobs Act for whom this ability to get a qualified business income deduction was made by electing to have a cash balance plan. Yeah, so I really like this chart. Typically with the cash balance plan, the employer also has a 401k plan. So let's take a look at how that works. So within the 401k plan, the business owner and employees can have 401k deferrals, which can be 401k or Roth of $19,500 and $6,500 catch-up if they're age 50 or older. And Roth becomes very attractive for the situation that an employer has a significant cash balance contribution. So they are getting a tax deduction for the cash balance contribution, but to have $19,500 or $26,000 if they're age 50 or older as Roth makes a lot of sense. Still within the 401k plan, they can have a company match, which can be discretionary or safe harbor QNEC contributions. Typically for an employer with employees, the QNEC, the qualified non-elective contribution, is more attractive because it helps in the compliance testing. Then finally, the third bucket in the 401k plan is for discretionary profit sharing contributions. Total contributions to a 401k plan cannot exceed $57,000 plus $6,500 catch-up contribution for a total of $63,500. But there are many individuals out there, probably mostly in my baby boomer generation, who have not saved enough for retirement to date, and they would like to greatly accelerate their retirement savings. So you can add a cash balance plan to get additional tax-deductible contributions. Now, a cash balance plan is a type of defined benefit plan, so that allows for actually larger potential tax-deductible contributions. The company guarantees a specified benefit and also an interest crediting rate, which we will go over later in the presentation. The cash balance plan is a qualified retirement plan, just like the 401k plan. So when an individual terminates employment or retires, they can roll their benefit into an individual retirement account. But it is two plans, so there are two IRS Form 5500s that have to be filed. There are two plan documents that have to be prepared. Both offer ERISA protection, and both are qualified retirement vehicles with preferential tax treatment. I mean, one of the elements of tax beneficial treatment is that investment earnings are also tax deferred until retirement. Somehow that often doesn't get mentioned. Okay, so let's look at prime prospects. I've tried to add to this list, and because of the pandemic, try to get you an idea of the new employers out there who are considering a cash balance plan. So the ideal candidates include owner-only employers. Let's see, didn't specifically, just got a question this morning about an individual who is a W-2 employee but also has a side business where they get a 1099. The income in that side business can be used to develop a cash balance or 401k plan. Medical groups. So certainly some medical groups were slowed down by the pandemic, but others kept right on going, and they could well consider a cash balance plan. Also, CPA firms and law firms. My experience over the last several months was that CPA firms and law firms, I mean, they worked remotely, but they just continue right in business during the pandemic. So they could be an ideal candidate for a cash balance plan. Financial service industries, consultants, hedge funds, IT. We've certainly done plan designs for several IT firms. Don't ignore lobbyists. And by the way, there's not only lobbyists in Washington, D.C., but there's also lobbyists in probably every state capital in the country. So we happen to be close to Harrisburg, Pennsylvania. I'm in Lancaster. There are several lobbyist organizations there, and they've been super busy lately because not only is there legislation related to the pandemic, but it's an election year, if you didn't already know. Also paid board members. We often see this, either an individual has a W-2 income and they're on several boards of directors and they have additional income from that. That can be used for a cash balance plan. Or they're basically retired, but they do have a couple of board memberships that they get paid for. Plan design that we just did was a cleaning company and suppliers. I probably don't have to tell you why that is a candidate for a cash balance plan. But typically we are looking for consistently highly profitable professionals and businesses. I mean, my comment would be that if an employer can be successful during the pandemic and they've been successful in the past, they're probably a great candidate for a cash balance plan. So let's look at a few specific ideal candidates. First of all, the candidate we're looking at here currently sponsors a defined contribution plan. So the cash balance plan would simply be an addition to the plan that she already has. She looks like she's younger than I am, but she may also be a baby boomer, so she may have put off saving for retirement. An overlooked potential benefit of a cash balance plan is that sometimes employers want to benefit key staff. We have several cash balance plans where key employees within the business also receive significant benefits. It could be that an individual owns a business and they're looking for a path to fund succession planning. So by providing a significant benefit to the business owner in the cash balance plan would give them the cash funds to retire and have the next group of the family enter the plan. Any form of business can have a cash balance plan. I've tried to list them all there. A question I get quite frequently is, my client gets a 1099, can he have a cash balance plan? And the answer is yes. That if he or she is not set up a formal business, then they're a sole proprietor, and sole proprietor income is available to be used for a cash balance plan. So what's different for 2020? Yeah, I guess I would say that the Pension Protection Act was passed in 2006, and then there really wasn't a lot of legislation that impacted qualified retirement plans from 2006 until 2017, the Tax Cuts and Jobs Act. Now we've had a flurry of activity, the 2019 Secure Act, and then all the legislation related to the pandemic. So the Secure Act had two very significant elements in it that affect qualified retirement plans. The first one is that plans can be established until the due date of your tax return. And that's effective for the first time in 2020. So for 2019, you had to set up a plan by the end of 2019. But for 2020, you're going to have until either the due date of the tax return, or that can include extensions. So that could take you the whole way to September 15th or October 15th, that you could establish a plan that's effective in 2020. The other big change is there's a possible tax credit for the expense of establishing the plan. So we'd have to look at that on a case-by-case basis. But if an employer has not had a plan for the last 3 years, and let's say they set up a 401k plan and a cash balance plan for 2020, and there's other parameters involved, but they could be eligible for a tax credit for 50% of their expense in establishing the two plans. So that could make the 401k and cash balance plan even more attractive. Let's take a look specifically at the availability of deductible contributions through having a 401k and a cash balance plan. So in the first column here, you see 401k. The only change there by age is that at age 50, you become eligible for the catch-up contribution, moving you from $19,500 to $26,000. Then 401k with the profit-sharing contribution. So $57,000 if the individual is below age 50, and then that $6,500 catch-up increases the total amount that can be put away into a 401k plan with the profit-sharing contribution. And then cash balance. So cash balance does depend on age. We just came up with a rough number for the age bracket that we show here. But let's take a look. Let me go to the next slide. Oh, here we go. Yeah, so I'm highlighting here the 45 to 49 set of information. So somebody between the age of 45 and 49 in the right situation could max out a 401k with a profit sharing feature with a cash balance contribution and put away $182,000 on an annual tax deductible basis. So you can see how that's much greater than the $57,000 that could be accomplished in only a 401k plan with a profit sharing feature. Let's take a look at some specific examples. So here is a 63-year-old owner. Let's say that they, well, very roughly, let's say that they have $600,000 of 1099 income. And so they approach you for a plan design. And really, because they're 63, maybe they're in a very good position financially. They certainly don't need all this income on a current basis. So this individual could put $283,000 away in a cash balance plan, $25,000 401k deferral. Actually, that's now $26,000. $16,800 in a profit sharing plan. So you can see that this individual can put away well over $300,000 on an annual tax deductible basis. So this design consists of two plans, a 401k and a cash balance plan. There are minimum funding requirements for a defined benefit plan. There's complex annual testing even in a solo plan. And we look at that compliance testing in a complementary plan design that we do for you if you provide us with the information. And we always recommend that the employer contact their CPA to discuss potential tax savings, and so that the CPA knows that this is coming down the pike. And here's another example. And part of the reason for this second example is that, okay, the second example is, oh, there's the 324. So in the second example, there's a specific point that I wanted to make. And that point is we were approached by a financial advisor, and they had a 40-year-old client who was a solo individual, and the financial advisor was thinking, you know, $57,000 that they can put away into a defined contribution plan is probably the max that they can do. But we were able to show them that there's an opportunity for an even larger amount. So if you look at the contribution report summary, so this individual is now able to put away $135,296 as compared to the $57,000. That is the maximum that they could put into a defined contribution plan. And again, as always, the employer should contact their CPA so that they know that this is coming down the pike. Now, I've only talked about solo design so far. Cash balance plans are very common in professional practices. So I'd like to show you a plan design, special dentistry practice with several employees and a younger professional working their way up the ranks, who's listed as the last employee. I had to go back and forth with many plan designs with this particular employer, but to make a long story short, this employer was able to put away significant amounts of money. You can see what the cash balance contributions are for each owner. And that varies by age. That's why those numbers are what they are. But with that, even with that substantial contribution, the contribution that they're making for their employees, if you go down to the bottom right-hand corner, is $32,750, which is 8.1% of compensation. With their prior defined contribution design, they were making 7% of compensation. So with a small increased contribution for employees, they were able to put away $638,000 or $710,000 if you include 401k deferrals for business owners. So this was a very attractive plan design. This plan is several years old, and the owners are quite pleased that they are now on a path to actually have a financially secure retirement. So, of course, we get asked, are cash balance plans expensive to sponsor? So I'd like to share with you this, we just did a solo slide here. We have a more complete exhibit towards the completion of our presentation. And by the way, this is the total price. This employer might be eligible for a tax credit from the Secure Act, which could, in theory, cut these expenses in half for the first 3 years of the plan. But a solo K plan, the setup fee is $175. For a cash balance plan, it's $1,800. So the annual one-time setup is $1,975. And then ongoing is $2,250, $450 for the solo K, $1,800 for the cash balance, for a total of $2,250. So after that first year, the annual expense is going to be $2,250, which is pretty, I think, a pretty reasonable cost for the tax benefits that we've discussed in the earlier slides. And as I said, we'll have a more complete fee schedule later in the presentation. So, successful approaches and timelines. Let's take a look at Dr. Lorna Chen. She has her own practice and is on a medical faculty at a local teaching hospital. So she has a 401k plan in her private practice, and her daughter just joined the practice. A long-term succession plan is needed. It was very, in my past experience, was very gratifying. I had a client who had a small pharmacy, and his daughter became a registered pharmacist. So he set up a similar type plan to a cash balance plan. And then when he retired, his daughter took over the business. He kept his license up, though. He worked like a day a month. And the daughter was thrilled that she had a licensed pharmacist to step in for the situations where she could not be at work or whatever. So that's the type of succession plan that Dr. Lorna Chen could have. David Harrison, CEO at Tomorrow Tech, age 50, one of these individuals that has not saved for retirement to date. I mean, we certainly run into many professionals who have had a very successful career, but that balance in their retirement account is not anywhere close to what they need to ultimately retire. So let's look at the life of a cash balance plan. So the financial advisor, that's you in many cases who are listening in on this presentation, identifies a candidate who fits the cash balance profile. TRA will provide a customized plan design with options based on the candidate's tax and savings goal. And in the next slide, we'll show you what that questionnaire looks like. Certainly, you know, we need name, date of birth, date of hire, income level, and what that candidate wants to put away for retirement. We want to get the CPA involved as soon as possible so that CPA can evaluate tax savings. This is where you may have a surprise that I know when I get my return prepared, there's a section of it prepared by my accountant that says what is my tax bracket? But there may be other areas that we mentioned in a prior slide, state and local taxes, et cetera, that factor into the equation. Okay, then the financial advisor, works with the candidate to design an investment strategy that meets the interest crediting goal. We typically use an interest crediting rate of 5%. So certainly there needs to be a fixed income and an equity component to meeting that 5% interest crediting goal. Don't be too concerned about that goal. It's a long-term goal. So certainly some years you'll be less than 5%, some years you'll be over. If you are cumulatively less than 5%, you have 7 years to make it up. And typically that's long enough to make the plan well-funded again. Then TRA, where we give service after the sale, we provide administration, compliance, reporting, and individual statements annually. We have you'll be assigned to somebody who will work specifically with you, a client relationship manager. So you'll have good contact with TRA for any questions that you might have. Then the financial advisor, TRA, and CPA provide ongoing consulting. Certainly, as I mentioned, that's included vision of the plan design this year. Because of the pandemic, in some cases, not as many as I thought it might be. And then ultimately, TRA terminates the cash balance plan. That's typically when the owner is ready to retire. Benefits can be rolled over into an IRA or whatever, and then used at the discretion of the employer for retirement. Okay, here is the questionnaire that TRA uses to get information from about your specific client. So the more information you can give us, the better design we can do. Certainly, we looked at examples where it was the maximum, but cash balance plans can be designed to provide less than the maximum benefit. So if an individual wants to have half of the maximum benefit, we can do that as well. And we work with you to identify the tax savings. Couple notes on here. We need the census of the employer. And if there's an existing 401k plan, we need the adoption agreement for the 401k plan, because it's a combination of the 401k plan and the cash balance plan that's meeting compliance testing. And again, what's new for the 2020 tax year? Plans must be implemented by no later than the tax return due date for 2020. So that can be, September 15th, et cetera. And there's still some glitches to be worked out for the filing of that first plan, Form 5500, which would typically be due July 31st, 2021. So if a plan is set up in August, how do you file a 5500 by that date? But I'm sure that will be resolved, and it just shows you how far out we can go and still establish a plan. And there was logic behind the Secure Act and why they did that. This gives the CPA and the client the ability to look at the numbers for 2020 after the year's over and say, oh, wow, we had a good year. We can begin a cash balance plan, because if we can make it through a pandemic year, we can make it through almost any year. Okay, cash balance investment strategy. Certainly you need to make sure you know what the interest crediting rate is for the plan. We typically use 5%. That happens to tie to the calculation of the maximum benefit that can be received from a defined benefit plan or cash balance plan. There's hundreds of pages of regulation on the interest crediting rate. So that's there is a lot of flexibility, but for a smaller plan, adding that complexity, we need to make sure that there's a specific benefit to that. So it is a challenging effort by the financial advisor. Return in excess of the interest crediting rate may limit future tax-deductible contributions, and returns less than the interest crediting rate will increase required future contributions. So an advisor needs to strategize. As I mentioned earlier, the assets can be held in the platform of the financial advisor. So that gives you a lot of flexibility as a financial advisor to set up the plan. And here is our total pricing matrix. You could follow the Solo K and Solo cash balance information that we provided earlier. We also show the 401k with the plan document maintenance program. With some 401k platforms, we have the ability to adjust the pricing. Also, I'll just put in a brief comment on 316 services, very economically priced and can move your plan to a whole new level with respect to compliance with IRS rules and regulations. So Bill, I think I'm going to turn it back to you for any questions that might have come up.
Thank you, John. Great job. We do have quite a few questions, and with respect to everyone's time, I'm only going to be able to answer a couple of them. And as I mentioned at the beginning of this presentation, if we're not able to answer your question, the respective RSC will follow up with you on a personal level and answer any other additional questions that you may have. First question, John. Can you explain the difference in making cash balance contributions versus just keeping a high percentage of the business income in their S Corp?
Yes. Well, I think the major point there is that when you leave profits in your S Corp, you pay taxes on them. By instead putting them into a cash balance plan, you get a tax deduction. I hope that's a sufficient answer.
And there's another tier to that question. And isn't there a lifetime maximum people can put into a cash balance pension? What happens after the level is reached?
Yes. Well, using today's maximum numbers, the maximum contribution that a 62-year-old can put into a cash balance plan is $280,000. And if they've had the plan for 10 years already, the maximum benefit they could have is 10 times that, 2.8 million. And yes, we work with employers as they approach that 10 years of having a plan to go ahead and terminate the plan at the end of that 10 years because they can no longer, if everything's been maxed out, they can no longer have a tax deductible contribution.
Thank you. Next question. Does a cash balance plan require the company to post a profit like a SEP, or could they run a break-even business on paper and still use a cash balance plan?
Well, when you describe break-even, I guess I would call break-even after the deduction for the contribution to the retirement plan. So at that level, you could run a break-even business.
Thank you. Next question. What is the minimum profit level to consider a cash balance plan?
Yes. Well, the first element would be the fees you're going to have to pay to have the plan. So certainly that would be a factor. But certainly it would be advantageous to have 50,000 of profits after your contribution to a 401k plan to designate towards a cash balance plan.
Thank you. Next question. How many years must contributions be made?
Yes, this is a question that we get frequently. Certainly the IRS intention for a cash balance plan is that it be permanent. So typically they want contributions for several years, but there are a lot of reasons why you can freeze or terminate a cash balance plan before that time period, such as a pandemic. So certainly any employer who set up a plan in the last few years would have flexibility to freeze and or terminate the plan if the pandemic is adversely affecting them. But also adverse business conditions, sale of the business, retirement of the business owner. It's an issue that you need to watch, but there could be flexibility beyond what you're thinking in terms of how long you have to keep that cash balance plan going.
Thank you. Next question. How does underfunded situation arise for a cash balance plan?
Okay. So, certainly one example is where a plan has a 5% interest crediting rate and the rate of return is less than 5%. Also, cash balance plans have minimum required and maximum tax deductible contributions. So typically the minimum required contribution is less than the cash balance credit. So if an employer always contributes the minimum required contribution, the plan is going to be underfunded. So that's a couple of examples.
Thank you. Next question, and again, with respect to time, we're only going to have time for a couple more questions. How are the contribution formulas designed in the cash balance plan document?
Yes, well, this comes out of the plan design that we provide to you and your client. And we typically design it to meet the goals of the employer. So in the solo case, that might be, I want to maximize my contributions, and we showed that in a couple of examples. Other cases can be, let's say if there's employees that they have a specific goal for what the employer wants to put away on a tax deductible basis. And to be clear on something that I mentioned earlier, the cash balance credit can be different for different participants. So it likely is going to be different for the business owner and any key employees, larger than it is for the employees. So all this goes together to pass IRS compliance testing, and that's how we get to the end of the cash balance design.
Thank you. And another question from a previous question. So the first question was, how long must contributions be made? Subset question. So if it's not recommended for a business where because of COVID-19 revenues are significantly more than in previous years. If you'd like me to repeat that, I would.
No. Well, if that's a one-time occurrence, that could be the case. Yeah, we have sometimes gotten requests for a plan design for a personal injury lawyer who had a huge settlement in 1 year. That's probably not a good example for a cash balance plan, but often that same personal injury lawyer has a structured settlement where he's going to get paid over several years, or he or she is working on other cases, so that can make it attractive. So I hope that answered the question.
Thank you. Next question. When do PBGC premiums apply?
Yes, that's a good question, and I didn't go over it during the presentation. So for any non-professional business, if there are employees in the plan, then the plan must be covered by the Pension Benefit Guaranty Corporation, which is a federal government agency that insures plans for the case when they are underfunded and the employer goes into some type of adverse financial circumstances. Professional corporations do not need PBGC coverage unless they go over 25 participants. So the solo plan designs that we looked at are not covered by the PBGC. The professional practice that we looked at is not covered by the PBGC because they did not have 25 employees. But a tool and die shop with 5 employees would be covered by the PBGC, and a professional practice with 40 employees would be covered.
Thank you. And last question, what is the typical turnaround time for getting a proposal? We could probably turn these around within 24 hours.
Yes, yeah, we work on, I mean, certainly in the solo cases, we can turn that around very quickly. If there's a lot of employees, that makes the plan design more complicated. Yeah, the turnaround can be a few days in the worst scenario.
And then I just received an update. Cash balance illustration expectations is 1 to 3 business days.
I agree.
Excellent. So we're going to go ahead and wrap up this webinar session, again, with respect to everyone's time. If you'd like to continue this conversation, you can contact your TRA regional sales consultant directly at 888-872-2364. And in the next couple days, I'll be sending a follow-up email with a copy of the presentation deck and a link to view the recorded webinar. Again, we appreciate your time and participation. Thank you very much. Have a great rest of the day. Stay safe and stay healthy.